Good morning. How are we all doing? You know, I think I have so much time to say hello to everybody. It's like, oh, it's like 9:30. I got plenty of time. I look down, I'm out there talking like, oh my gosh, it's 5 after 10. I got to get up. I have no microphone and everything. So I apologize. I always think, I think what I'm going to do is stand at the door. I guess I'm going to say, good morning, hello, how you doing? Because I don't think I got to talk to half of you. And I like the smaller venues because I thought I could do that. But I didn't get to talk to as many as I wanted to, so I apologize. So we can talk afterwards, I guess. So I do want to say Happy Mother's Day to all the mothers in here. We didn't realize when we set this date that it was Mother's Day weekend, and some people saying, oh, Brent, I wanted to go, but we can't because we're going out of town to see our kids. We have our family coming in. We got a house full of kids. So I do want to say Happy Mother's Day to all the mothers, and again, you know, didn't turn out, the turnout is a little bit lower because of that, but I still like, I think we had like 90 people here, which is much better, and I'll just ask again, the 2 quarters ago, we had like 190 people show up. Do we still like the smaller venue? Yeah, good, okay. Okay, you always know I ask you a trick question, so I'm kind of setting you up here to see how smart you are, okay? And the answer has been in the room somewhere around here, okay? So I'm kind of helping you out a little bit. All right, let me ask you, in this room, how many people own stocks? Aha. See? Okay, put your hands up higher so I can really see them. Don't be shy. All righty. Okay. All right. You know I'm tricking you, right? How many clients in this room own small pieces of large businesses for 3 to 5 years? That's the right answer. You know, all the time I tell people, it's not a stock market, it's a market of stocks, it's a market of businesses, because there's a big difference mentally. If you think you have stocks, you get tied into the hype of the stock market, and it makes you think crazy things. When you say, no, I own a small piece of a large business, and if you're a business owner, you know that business doesn't go good all the time. You know it goes up and down. The attitude and the feelings are much better when you understand what we're doing is we do not play the stock market. We do not try to figure out what the stock market does. We look at the stock market to try to find companies that are good companies that we think can do well in the next 3 to 5 years. So again, I figured about half the room was going to raise their hands because of the stock question, but you do not own stocks. You own small pieces of large companies. With that said, we appear to be in a difficult cycle where not much is happening. This kind of reminds me, and one thing nice about being older, I now have over 30 years of doing this, and there's been great times, and there have been times, well, not so great. And this kind of reminds me of 2001, 2002, where for like 2 years, not much really happened. And over the last year, you know, we've had some big gains and then big drops and so forth, but we've been here before. And what we're actually seeing is now we're in the spring of 2016. The spring of 2015 was what I call a peak. So what happens is that sometimes you measure peak to valley, it's not very good, or peak to peak is what we're doing now. It's like, oh gosh, it's been 1 year, nothing's really happened. Now in between, a lot has gone up and down and so forth, but this does happen in investing. And that's why I always tell people when they come in, out of a 7-year period, you're going to have a couple losing years, okay? And they may be at the end of that 7 years, maybe at the middle, they may be at the beginning. I can't tell you when they're going to happen, but it just happens that when it comes to investing, that's kind of how things go. So, but what we do is during these time frames, our job is to try to maintain the capital, stay away from the urge to like, oh my gosh, we're not making any money. And this is a big mistake that a lot of brokers will make because they feel bad you're not making money, and they'll start increasing the risk. Well, we're not going to do that. I'd rather take your phone call saying, gee, it's been a year, we made no money, what are you doing? Well, I'd rather do that than say, okay, well, we're going to buy Netflix at 130 because everybody else is buying it, and then we lose 50% of it, which we know will never come back. So that is a difficult part of investing. I got to talk about oil, okay? Last quarter, if you were here, I know I asked people how many were upset with oil and so forth. I think a lot of people raised their hand and so forth. Well, oil has come off the bottom, trading recently around $45 a barrel. Remember, oil was about $26 a barrel when I spoke last time? And the word was, oh, it's going to $10, it's going to $15 a barrel. And what I always say is it's possible, but not likely. Well, oil has rebounded to about $45 a barrel. Some of our companies, like Parker Drilling and PDS, which are oil companies, they have, from the bottom, they're up 100, 200%. Now, it's not over yet. Some of you are still underwater in those two companies. They will come back around, but at that time, there were many people who thought that, oh, those companies are going to go bankrupt, they're going to go under because oil is going to do this and that and so forth. And I said, no, things will change. And things, even 3 months ago, I could not foresee that there's going to be a fire in Alberta, Canada, that's going to shut down the oil up there. You just can't foresee that things. But this is the way life kind of works sometimes. You don't know what's going to happen. Also in Libya, do you remember me saying these words? Since when did the Middle East become a stable place? It's not. And to count on that happening is crazy. I mean, Libya now, that they're having, you know, all kinds of violence and so forth, and they're not a big contributor, but it could be the start of that. So we just can't say that oil is going to $10 a barrel. We have to say, you know what, we own a couple of companies in the portfolio. They're not doing right now, but we own good companies. We'll talk about Precision Drilling today. We'll talk about the cash flow and their debt, which we talked about Parker Drilling last time. So what you want to do during these difficult time frames is hold good quality companies. Even though that stock price might be down, they'll weather the storm, and then 2, 3, 4 years later, like, oh, wow, you will forget about it, but it will do better for you. Let's see. You know, I always talk about how hard investing is, and it is hard. You know, nothing in life ever goes perfect for you. Anybody here have a perfect life? Everything goes perfect? It doesn't happen that way. You know, one thing I try to tell stories related to, and actually Chase is now in the room, so I'm going to pick on Chase a little bit. I'm going to talk about his freshman year of football. And his freshman year of football, it was terrible. I think they had about 9 losses in a row. I think the season was like 2-13. And I often wondered, like halfway through the season, what must it feel like to put those pads on, that stuff, and go out there on Monday and practice 5 days a week, and then play on Sunday or Saturday, whenever they played, and pretty much know you're going to lose again. But that's kind of what makes you through life when you have those difficult periods. But because he did that, when high school came around, his senior year, well, because he stuck with it, he was a star. He was one of the star players, got awards and accolades and everything else. And then he also got to go on to play in college for a D1 school. Now, that wasn't an easy thing either, because the first college he went to, he kind of got, I won't go into the details on that, didn't do very well, got screwed on the deal and so forth. Then he goes to Northern Arizona, got put on the practice squad. Now, they should say the practice squad is actually tackling dummies. It's not very easy being on a practice squad, but it's a very difficult time frame. But then he made the team and so forth. And that was about an 8-year time frame, about that 7-year cycle. Life goes in cycles, and whether you're talking about football, you're talking about life or investing, it's never going to be easy, and this is why the average investor makes 2.5%, because they quit too easily. Like, oh, we had a bad year, I'm just going to quit and I'm going to go to this guy, or I'm going to get out of the market. There's still people, I was just saying this earlier, there's still people from 2008, 2009 that sold at the bottom and still are not back in because, oh, stocks are risky. And I say this all the time. Every one of you heard it when you first came in. I'm wrong a third of the time. We're not going to do well every single year. But when I look over the past 10, 15, 20 years, I mean, my own account, I mean, I started with $5,000. I won't tell you exactly what it is, but it's in the 7 figures now. And it's not been, oh, I've made like 20, 30%. It's been that steady growth of averaging what I always say, we do on average 8, 10% per year. And with the time, doing the right companies, we can do that. And I'm more worried about losing the principal long term than I am about making quick money short term. Okay? You have questionnaires. So do you feel a little bit better? I mean, I just got to keep you on track because these are hard times. When you don't see anything for a year, like, oh my gosh, why am I doing this investing? It's been a year. I made no money. We had a caller today called in and he says, well, I'm kind of down the stock and I've been holding it for long term. I go, well, how long you hold it? 7 months. Yeah, I'm glad you all laughed because you get the joke. I said, well, long term is like 2 to 3 years. You know, give it 2 to 3 years. And it's hard to do that sometimes because it is hard to get up like, oh, there's the red on the market. But I don't care because we own businesses, small piece, large businesses. You have questionnaires, and we have 2 very important questions for you. We've thought about if we had a CFP in the office, which is a Certified Financial Planner, and we charge $500 for a financial plan. And if you need financial planning advice to try to figure out certain things and so forth, at $75 an hour, would that be reasonable, or would that be of interest to you? And the reason I brought it up, because from time to time, people ask me this stuff. And you just want to have that financial plan to maybe grab onto. Well, I look at other companies, and some of these financial planners, they charge $300 an hour. That's like $2,000 for a plan. You get a book, and they slam you into mutual funds, okay? What I'm thinking, if you're of interest, and we'll do this if we can, is to have a CFP in the office where you can come in, talk to the CFP, and actually do the financial plan, but we'll still do the investing for you. So nothing's going to change on that side there. So please put down your thoughts, and again, don't be afraid to say, oh, we don't need that and so forth. We want your honest opinion, what you feel. If you'd like to have a CFP in the office, you can actually talk to them about financial planning. Number 2 on the questionnaire is the other question I hear too is like, Brent, I love the portfolio. It's the individualized concentrated value portfolio is what you're all in. I like that. I know it's long term. But I've got $200,000 in the bank. I don't want to put that over there because that's longer term. You always talk about the 3 to 5 years. But gosh, I'm only getting 0.1% in the bank. Is there something in between? I've always said I don't like bonds because of the fact I know when our rates go up, bonds will go down. So I started looking at what we're going to call the DIP, Diversified Income Portfolio, okay? So what it is that we're looking at, we believe we can come up with a 4% yield for you. I would recommend a horizon of 2 years. It's not a CD, it's a diversified portfolio of corporate bonds, of short-term bonds, of international bonds, of bank notes. So it's a diversified portfolio of bonds. And we've looked at the study on this in the past, and what happens, they don't all move in the same direction. So I'm not as concerned if our rates go up, the portfolio part of it will go down, but the other part could go up. So we're feeling pretty comfortable with that from our study and so forth. So if you have interest in that or you like that idea, please let me know, because again, if you do, we'll actually enact it and do it for you. And it does not replace your current portfolio, because your current portfolio is the best long-term investment. But again, if you're in that middle where I've got too much in the bank, but I just don't want to put into the long portfolio because I may need it 2 or 3 years down the road, that's why you come up with that. And again, no interest in that, that's okay. We're just trying to think how else we can kind of help you and other people as well. Okay, I guess that's all I had. So you know what, I know I'm I'm way behind. Okay, let me go ahead and get started with the numbers. Okay, all right, let's just talk about the S&P 500 index. I did a couple different things here too for you as well, as I drew some other numbers here. See how it says see S&P 500 EPS? What I want you to see is how this is, let's see. Oh, here we go again with the colorness, okay. There it is. How you can see this is going up here. Well, we have kind of gone a little bit of downturn here. But when I look at the next graph, look at this right here. S&P 500 inflection points. So what you have to look at, yeah, the S&P number is going up and down forth, and I hear people, oh, it's going to crash and so forth. There are companies out there that are way too pricey. We don't buy those companies. We buy the ones that aren't too pricey. So the S&P may have a pullback, but look at the earnings here. They are increasing. So we're not at a great buy. I mean, back here was a great buy over here. Same thing going back to here, is great down here. But again, we're not at the point where, oh my gosh, things are going to crash and it's going to be 2008 and I'm going to lose 50% of my portfolio. That is not going to happen. Can I be clear on that? That's not going to happen? Okay, all right. I just want to make sure that's clear. When you look at some of the sections here, returns by the sector, we see energy, 2016 is actually positive 4% after being negative 21. Consumer discretionary 1.6 versus 10.1. We like to buy things when they're on sale. We don't want to be buying, who's the top one here? Telecom, 16.6%. That's just too expensive. You don't want to, see if you ever heard the saying before, I got a great idea about investing. Let's buy high and sell low. Is that a good idea? Okay, we don't want to do that. We want to buy low and sell high. Market volatility, I want to show this too because we get worried about things like, oh my gosh, I've not made any money in the past year. You probably don't remember, July 2010, we were down 16% at one point. 2011, 19.4. 2012, 9.9. Here we are right here, 2016, February, 13.3 decline. you're going to have these declines in the portfolio. They can be 10 to 15%, but we're not looking at where we're going to be 12 months down the road. We're saying we're going to be 2, 3, 4, 5 years down the road. These things will happen, and I bet if I asked you, didn't put the screen up, and I said, okay, how many times since 2010, over the last 5.5 years, have we had a pullback of 10% or more? You might say, oh, I think once, maybe twice. You really don't remember those. Again, it's that tricky thing about life and how things happen. So it's going to happen again. We might have it. I do believe by December 31st, we will be higher than we are right now, but I also do believe there's going to be another pullback between now and then. So be prepared for it, but don't panic about it because our businesses are doing pretty well, which we'll talk about in the second half here. And as you can tell, I'm trying to speed this up a little bit because I'm way, way behind. So I apologize for talking quickly. What you can do is you can record it and then play it at half speed so you can understand what I said. All right, and I will slow down for the important stuff. I want to show you here corporate cash. We can see how much it grew. Now it's kind of leveling off because companies are starting to spend some cash. They're starting to buy stuff, starting to do things with it. They're buying back stock. They're paying dividends and so forth. Over here, we see share buybacks. We see dividends per share still going up. So that's positive. We've seen, like Apple just increased their dividends. So companies are increasing dividends, which does help. We see over here the S&P profit margins are still high. They've come down, but they're still high compared to history here. And that's very important because, again, on these businesses that we buy, we want to make sure that they're making profits because if you make a profit, you can reinvest it in the business. And again, 3 to 5 years down the road, wow, look how well we did. The length and strength of expansion is very important here. Everybody thinks, oh, it's going to be over and so forth. Well, look at where we're at here. This is how long our expansion's been. You can see here that it can go much longer. And the other thing, too, it depends on how the expansion went and what happened. We had a very, very deep decline, but we're not coming back very quickly. So what that means, the expansion will last longer, and people think, oh, it's going to be over because it's been 7 years. This should go on probably for another 2, if not 3 years. And at that point in time, we kind of change things, but as of right now, we're going to stay on the current path of owning our great businesses that have good earnings and cash flow and so forth. I want to compare this for you, economic growth and comparison, just to kind of show you where things were in 2010 and where they are now. We can see back here how it's broken up, and we can see here we had exports are actually better. They were negative 3.7, now negative 2.8. Consumption did go down a little bit for consumers. I was kind of surprised on that, but I think it's partly because the pie is bigger. What I was excited about, and you should be very excited about this one as well, government spending back then, 20.5, now 17.6. Our government is spending less money. So that's something you should always cheer about because our government is finally doing one thing right, okay? That was a joke, okay? I mean, I don't want to talk about the government, but that's a joke when I say they do one thing right. We do see investment in, what's that? Well, the government's, should we say the government's a joke or not a joke? I'm not really sure. But, you know, it's been that way for 100 years, and it's not going to change. That's where the government is, and that's why I tell people, don't get too upset about who the president is or so forth. We've had terrible presidents. We've had terrible Congresses. We make it through it because we have very smart entrepreneurs and very smart business people in our country, and our laws allow us to do that. So don't get too concerned about the government going to do this and that and so forth. And again, I am not a big proponent of government. I don't like government. I hate paying my taxes. And I'm like, oh my gosh, what a tax bill that is. But it is part of, again, this life thing we go through. Also, too, we see investment ex housing from 10.7, now 13.2. Housing, 3.5. So again, things are going in the right direction. And that, again, is a 6-year period. All right? This is the one I was kind of looking at here, was the consumer balance sheet. Here again, back in 2010, we can see the total assets were 69 trillion, total liabilities 14 trillion. Look at this now. Fast forward 6 years, 2016, total assets $101 trillion. And you can also see the breakup of that as well if you want to compare those. But what is very interesting, and have you ever heard like, oh my gosh, next thing is going to crash would be student loans. Did you hear that story yet in the media? Isn't the media great how positive they are? I mean, they want to find the worst thing and say, oh, this is going to be the next thing. Well, look at this. Our liabilities back then were 14 trillion, 69 trillion, 101 trillion, 14.5 trillion. That's only $500 billion more. What is the media talking about? Well, they're trying to scare you to get you to watch TV. Our assets are about, what, $32 trillion, liabilities of $500 billion, okay? That's a positive. Consumers are doing okay as a whole. And you can always find that one crazy Louie that is way over leveraged, is going to lose his job and everything else. They're always out there. But as a whole, America consumers are doing okay. We can see here light vehicle sales. We own a company manufacturing our portfolio. Still doing well. They're about 16.5 million units a year that they're making. They're still making a lot of cars. We had, because of this right here, a lot of cars need to be replaced. You can see here the average car age right now, 11 years old. Average truck is 13 years old. These will have to be replaced. They can't be around for very long. So car manufacturing should do well over the next 2 to 3 years. We see housing starts. Look at this right here and how bad it was. It's increasing almost up to the average, but we have more to go. That's why you own a builder in the portfolio, which I will talk about the builder as well today. We can see here home prices, they are increasing. And what that does, it makes you feel better. When your house goes up in value, you feel like, yeah, I'm doing pretty good. I've got equity, and your loan didn't increase unless you went and borrowed more against it. But you feel better because your house is worth more. But even with that, home affordability index, still affordable, still way down here. So do you see why we own a builder in the portfolio? This is the part where you say yes. Okay, I know you haven't got your coffee and food yet, but I just want to kind of, this is why we call it like a client dinner or client brunch, where it's a kind of event where you kind of participate with me, okay? And I know I'm kind of quiet up here, and you're never really sure, is that a trick question? I kind of warn you with a trick question. So, okay, long-term drivers in the economy. I want to show you this one here, the growth in the working age population. The workforce is getting older, okay? That is happening, but growth in investment in structures is increasing. Why? Because we're becoming more productive, a lot more productive. And that's why I thought it was kind of funny. I was on KUSI talking about the minimum wage increase to $15 an hour. What businesses will do is like, okay, it's cheaper to actually get machines to do that if we got to pay a high school kid $15 an hour to serve you hamburgers like McDonald's, okay? So businesses will invest and do the best they can to make profits, and that's why this is growing. Our population is getting older. Okay, federal finances, I just kind of put this up here. Why don't I show you that GDP? Don't know how that happened. GDP, you can see it actually needs to keep growing, and it has been growing. If we get our GDP to grow, the federal debt will not be as bad. The federal debt is not going to go away, but if you're making more money as an economy, that debt will not be as a problem. We can see here the forecast is actually doing okay, all right? And there were forecasts before, oh, it's going to be 130%, 200%, and so forth. They base it and they extrapolate based on the bad information. Things, again, like oil, they change. So you can't ever look at the current data and just say that's going to happen in the next 10 years. Things will change. We can see here the thing we have, federal budget, about 50% is because as our population gets older, we're changing. That's changing. Okay, we're not building as much because we have Social Security is what, 27% or 23%, Medicare, Medicaid, 27%. So that's why the GDP needs to keep growing. Our economy and our population is changing. Unemployment wages, wage growth should begin increasing. Actually, the report came out yesterday. I think it was 2.6% increase over the year. That will keep increasing. So the employment report came out today or yesterday, and it was okay. It wasn't great, but we're now about a 5% unemployment, so we're doing okay. And remember these periods here? I heard people saying, oh, it's 10%. Where's my little thing? It's 10%. It's going to 15%. It's going to 18%. We always think the worst going out, or things that go like oil going to $10 a barrel. That doesn't happen. Things change as things move up or down, and you got to understand how things change. We see here labor force participation rate declined since 2007. I want to show why it's declining. The big thing is aging. As you get older, you're not going to be working. You're going to retire, and that means you're no longer in the force. You can see here, and you hear how bad it is, but do they tell you that? You can see right here the percent of what it is. Cyclical, well, that's not the reason. Other is because people, well, it kind of comes from people being in the hospital or disability or actually going to prisons and so forth. So participation rate is actually getting a little bit better, but you have to understand what makes up those numbers. And the media does not do that. The media just wants to talk about the negatives. And again, we can see it is improving, but I want to give you both parts, all right? Inflation, it's doing okay. We can see it was way up here back in the 80s, now down here. I mean, inflation is probably running around 2 to 3% real numbers. That's okay. I think we'll see it probably increase over the next 2-3 years somewhat. It's not going to affect us because if you own businesses, guess what happens? You own an iPhone, you're going to sell an iPhone for $700 an iPhone. Well, the inflation, well, sorry, the iPhone's now $725. What does that mean to you? Oh, you own the business? Oh, you get more money coming in. So you keep pace with inflation because you get to raise the prices of your products. The trade in the U.S. dollar, trade is doing better. Our dollar got very strong, and this caused problems last year because the dollar got stronger. The profits of our companies went down because of the currency exchange. What we see this year, it's coming down a little bit, so it's actually helping profits. So I think cycling forward 1 year, we're going to do better. I don't see the dollar doing this same thing here of increasing dramatically. It's probably going to jump up and down around this area here. I don't see it going back up here. I don't see it come down here. But it's not going to hurt the profits for companies. So going forward, profits will look better on companies, which means valuations looks better, which means, oh, the stock should go up in value. I want to point this out here. I want to try to give you good news. The media doesn't want to give you good news. I want to give you good news. This is state and local government debt service. Look at, you see where that line goes? It's going down. They're actually doing less. I saw in the paper today, Puerto Rico, their debt is terrible, they're going to default. They didn't show you this here. They just want to show you the negative, okay? I want to show you the positive to kind of offset a little bit about what you hear in the media. So, again, our municipalities, they're doing a little bit better. The European recovery, we got Michael Kors in the portfolio. Michael Kors, they have a lot of operations in Europe, so that's a concern for us. But we can see here, the European, the GDP growth, it's actually getting better. We can see here with the 1.4, 53.7, that's the manufacturing. We see the Eurozone employment is down, was 12, now it's 10.3. So Europe is an improvement. And I said they would improve because why? Because the United States, we buy their products. We buy the Mercedes, we buy the Porsches, we buy the Michael Kors purses, we buy things that are over there, which helps out their economy. So it's okay to have a Michael Kors, which is part of Europe. All right, gosh, I went through that fast. No, I'm still way behind here. So it is, are you hungry? Okay, did I talk too slow? All right, well, let's go ahead and release the tables. Are we ready for the food there? Okay, anybody have any idea how we're going to release the tables today? What's that? Where'd you come up with alphabetically? Well, we're not going to do it alphabetically. That was a consideration. No, what we're going to do is do it by the market cap value, starting with the highest company first. Kevin wins this anyways. The largest company in our portfolio is Allstate. We own $9.5 million of Allstate. So if you're, wow, it's a small table. So if you're at an Allstate table, you get to go eat first here. Okay? Alrighty, how's the brunch? All right, well, we're not going to the favorite part. Everybody loves the company part. We talk about the companies and so forth. But as I always say, we've got to go over the economic information to show you that things are not falling apart in the economy. That's why we talk about the car sales. We talk about the housing and so forth. Because if you listen to the normal media, like, oh my gosh, the economy is going to fall off the cliff tomorrow. And that's just not the case. It's not a boom economy, but we have some good things. Car sales, housing sales. So we got some good things here. So let's take a look at the companies here for you. First on the list is a Piedmont Office Realty Trust Incorporated. It is a REIT, which stands for Real Estate Investment Trust. It's number 12 on our buy list. Number of shares, about 188,000. As I said, about 3.8 million is what we own of it. Stock price in 2015 is up 8.1% in 2015. Current stock price, about $20.18. And they are a REIT, as we talked about. What do I like about Piedmont? What I like about is the REIT has remained strong over the last 12 months. It's up about 16%. So while some other things are kind of struggling, the REIT has held well, giving us some positive returns there. They just reported earnings on Tuesday. Funds from operations beat the estimate by a penny, coming at 41 cents. So they are making money, which is a big positive. We talk about the earnings and so forth. Current dividend yield, we get a 4.2%. So I like that dividend. We're waiting for things to happen. we get cash flow coming in to reinvest back in the portfolio. And we do not reinvest back into the company. We actually will take that cash and look for better opportunities down the road. Debt to equity, 92%, very important. This versus the industry at 202%. When it comes to real estate, we like real estate in this REIT because they're not highly leveraged. I've talked to many people that have real estate. If you over leverage it and things go against you, you're going to lose everything. So I am concerned over the next few years as interest rates go up. Some of these REITs, and this is the average 202, there's probably ones out there with 300%, meaning 3 times the debt to equity. They will have a problem as interest rates go up. They could have to be forced into bankruptcy. The real estate will be fine, but the REIT will not be fine. So we like the REIT, but we like that it's one of the lower debt REITs with 92%. What I don't like about it, well, the current buy price, about 1947, we're about 4% away from buying that. I like this. I like to put it in many more portfolios, but we have buys out there. They're just not triggering because it's not our target buy price. Even though the company has lower debt than the industry, I still worry about the effect of rising rates on the stock price. Why do I do that? Because the market in the short term is a crazy place. Even though we bought a good REIT with low debt, I know for a fact when interest rates go up, the whole basket of REITs are going to come down, including ours. Some of them will fall out because they're not well. Ours will return back to the top because of low debt. But I know it will come down because it's just a broad swipe of the brush where everybody gets hurt in the short term, and then the ones like ours, like, oh, wait a minute, they don't have much debt, didn't really hurt them. So, but in the meantime, we'll still collect that dividend. Year over year, revenue was down about 5% growth, while the industry was up 16%. So I would like to see them do a little bit better job getting some more on their rents. But actually, they did sell a building, bought a building. And when you buy a building, what happens that you're trying to rent that building, you give, I forgot the name of it, but you give like incentives where, okay, you don't pay rent for 6 months and so forth. So that hurts the revenue, but that will pass as time goes on as well. So we like Piedmont quite a bit. Number 2 on the list is, we just love this company. Pulte Group Incorporated is number 3 on our buy list. Number of shares was 413,000 shares, about $7.4 million we own of it. 2015 stock price change was a positive 2%. Current price is around $18 a share. They've been founded in 1950. And this company, I don't have it up here, but it is a home builder that is nationwide. And when I read the recent quarterly report on them, I was very surprised. I forget the exact number, but they actually sold more houses in Texas than they did the previous year, which is a surprise to me because Texas is oil-based. So this company is just doing some great things. They actually have, well, I'll just go on here. Earnings per share, look at this, jumped by 25% from December 2016 to 2017. When we bought this about a year ago, we knew this was the direction of housing, that there's a shortage of housing. Well, how do you fix that? You build more. It was a simple concept. Short-term PEG ratio, only 0.59. What that means is we're not paying very much for the future growth of the company. I like a low PEG ratio. We don't like companies with a PEG ratio above 3 or 4. I think it's a little bit too pricey for us. While we're waiting, we collect a 2% dividend for this company. So again, we got cash flow coming in. Even though the stock may not be doing very much, we get paid a little bit for waiting. And then love this one here. Backlog of homes from last year up 31% to $3.4 billion. I mean, I would love to say, gee, we've got so much money, people coming in, we can't even get to them yet, okay? As a business, you want to see that backlog because people want your product. They're willing to give a deposit for it. This company has some very, very good things going on. What we don't like about the company, there's been some discussion lately with the CEO kind of fighting with, I think he's the grandson of I think Robert Pulte was the owner, about, I think maybe some personalities rubbing there and so forth. So I believe he's going to be leaving in a year or so. That kind of took the company, and it came out just about when they announced earnings, so we didn't get that bump that we should have got because of this conversation with we'll call him the owner and the CEO. Cost of labor is increasing and difficult to find qualified labor. We talk about the employment numbers and so forth. They are having a hard time building these homes because they can't find anywhere, say the plumbers, the carpenters, and the electricians to build these homes. They've got the demand there, but it's hard to get the labor to build it. And it is amazing because some of these jobs pay $50, $55 an hour. I always talk about I shouldn't go this direction, but I will, about the everyone gets a trophy society. That's really hurt because some kids don't want to work. Like, well, I'm here, just pay me $50 an hour. I don't want to lift a hammer. I showed up. I get a trophy. So that has really hurt some of our labor. So yeah, I kind of went off tangent there, but oh well. I got to bring that up once in a while. Cash flow is a negative $64 million as the company continues to buy land. They are looking forward. Again, a builder is not looking out, again, 3-6 months. They're looking 3-6 years because it's a long time to get that. So really love this company a lot. We've tried to put it into as many portfolios as we can. Right now, it is above the target buy price. I know we do have pending buys on that, which have not triggered yet. As I kind of said, I think between now and the end of the year, there will be some pullbacks. I'll answer this question now. It's going to come up. With the election coming up, this crazy election we're going to call it, there's going to be a lot of volatility. So be prepared for it, but it will help us buy some more of these companies. Number 3 on the list is a Precision Drilling Corporation. PDS is the symbol. It's on hold. We're having a very hard time with the oil companies really come up with a good value of what to sell them at. We know they're at a decent value now. We don't want to sell them. But we can't say, oh, we got a target sell price of 6 here, okay? Having a hard time trying to get a target price to sell it at. It is well off the lows, so it's gone from a buy to a hold till we feel more comfortable to buy more of this. About $3.5 million on our value at WHAM, up 19.5% 2015. Current stock price around $471. Founded in 1951. A lot of these oil companies say, oh, they've been around for a long time. That's what, 60 years? We do see what I like about the company. February 11th stock was a low of $2.68. The worst seems to be over, and stock is now around 5. It was around 5, and then because of the fire in Canada, which is a Canadian company, it's pulled back to, I believe, around 460 or so. But again, it was above 5 because of the increase in oil, so I think we'll see return above 5 again for this company. Still has cash and short-term investments of $476 million, which is $27 million more than last year. And isn't it kind of crazy? Oh, things are doing terrible for the oil companies. Oh, wait a minute. They increased their cash by $27 million. Not as bad as you think, because the companies, if they do the right thing, they conserve cash, they can stay in business and do well. So they increase their cash, so that's why we stay with this company. Once again, cash flow from the company was positive, $112 million. So that means in the bank, they made $112 million. So even though the earnings are going down, it's because of depreciation, because of write-offs, all these other things, they're bringing more cash in. And what can you do with that cash? You can pay the bills and the creditors so they don't get upset and force into bankruptcy. So cash flow is very important when it comes to these oil companies right now. Earning estimates going forward are starting to improve as fewer analysts are seeing oil at extremely low levels of $10 to $20 a barrel. So we're starting to see those improve. So I'm hoping within the next 6 months we can get a better feel for what the value of these companies are based on earnings going forward. What I don't like about the company did have to suspend their dividend to maintain cash. It's kind of like a positive negative. I don't like they stopped paying the dividend for you, but again, we want this business to stay in business, so they're maintaining that cash for now. They can always start the dividend back up again, but they stop paying the dividend to make sure they don't go into bankruptcy. Range of estimates going forward, still not dependable, therefore we have no target price based on earnings. Liquidity is good, but debt to equity is still 98%. And while PDS has said they would love to pay down their debt, they have decided to retain cash. And the CEO said, he goes, gosh, because their debt is probably trading around 50 cents on the dollar, and they want to kind of use their cash to pay that down. However, they're saying it's probably not the wise thing to do if things don't improve for them, which they seem to be improving. Okay, lastly for me is Allstate Corporation, number 7 on the buy list. We own about 145,000 shares of it. Market value is about $9.5 million. Stock price up about 5.8%. Current price on 65. The stock's still about 55% away from the target price. I mean, this company just does everything you want it to do. I remember years ago, I've kind of said this before, but we bought around 40, fell to 20 because of big insurance claims with hailstorms and thunderstorms and tornadoes back east. Well, now it's around $65 a share again. We like this company. Pays a 2% dividend. Forward PE only 10.6. We're not overpaying for this company, which is very good. They continue to buy back their stock and has reduced their share count by 38 million shares over the last year. So they're really very aggressive trying to help you out as a shareholder by buying back more shares, because the pie is this big. If you only, if you take out more people from it, you get a bigger piece of the pie. That's what they're doing by doing share buybacks. They had in the current quarter over $500 million of catastrophic loss from hailstorms in the first quarter. That's going to happen. It's an insurance company. There's going to be times they have to pay out. But I always tell people what's great about an insurance company, all these people that had these hailstorms and filed a claim, you tell me, what happens when you file a claim with the insurance company? They raise the rates. As the owner, it's good for us. As a homeowner, it's not so good, but that's why we own businesses, okay? Earnings per share down 20% year over year. I wasn't thrilled on that, but again, that's because they paid out these claims. Over the last 90 days, December 2017, earnings per share has fallen 8 cents to $6.15, again, because I'm paying out on their claims. Alrighty, next up, Chase is going to take the next 4. Are you all mic'd up?
Yeah, I'm good to go.
All right, good. I'll give the clicker to you.
Perfect.
Alrighty.
All right, I was sitting back there just talking about my football career, and I was just thinking, wow, that actually relates to investing so well. We had some of the numbers wrong there. My freshman year of football, we went 3-7. JV, 2-8. And then junior year, 1-9. It's just like, oh my gosh, what is happening? This is terrible. But finally, senior year, we picked it up. We made it to the quarterfinals for football. And then my college career, that was awesome at NAU. We were ranked number 8 in the nation at one point. It was a great time. I know it relates to investing so well because I'm sure you guys remember this part. You'd like to block it from your memories. But when we do the presentation, we say, out of a 7-year period, we're going to have a couple losing years. Guess what? In 2000, 2001, 2002, we had losing years. What happened for my freshman football, JV, and junior year of high school? Losing years. But I didn't try and time when we're going to be winners. I stuck through it the whole way, and finally we were winners. So I just thought that was a good story. Great relation, Dad. I didn't even think about that. But let's get back to the company. This is my favorite part. Love to own these small pieces of large companies. Can't express this enough, as he talked about in the beginning. It's not a stock. And I always tell my friends, oh my gosh, what you do is so risky. It's not risky. I love what we do. We own, let's see, Vishay, not a big name here. I was hoping it was a bigger name. But, we own these small pieces of large companies. And while Vishay is not a big name, another company we love. It is currently a hold on the WHAM buy list right now. Own about 465,761 shares. Market value about $5,784,000. 2015 stock price change up about 3.6%. Current price around $12.42. First thing we start off here, what I like about Vishay. Price to tangible book, only 1.3. That's well below the industry average of 5.02. And I love the tangible book value. That is probably one of my favorite ratios to take a look at. The other day on social media and our Smart Investing Daily Briefing, which are now on our website, we actually took a look at what intangible assets are and why it's so important to take a look at the tangible book value for the company. And again, this is a great ratio. That means you're paying 1.3 times the amount for Vishay's assets, the tangible assets too. That's things like this chair, this stage, not these intangible things we can't touch. Great to see that. Another great thing, their balance sheet, extremely strong. Look at this, a current ratio, 4.12. That means they have 4 times the current assets over current liabilities. That should get you guys so excited. I love to see that. Why does that excite me? Gives Vishay a lot of flexibility moving forward. They can buy back stock. They can go out and buy companies. They can do all this stuff with the cash. Love to see that. Again, debt to equity, speaking to how strong their balance sheet is, only 26.9%, well below the industry average of 39.8%. Another thing I like about them is they did kind of go through some problems last year. They dealt with a factory exploding, but it seems like they're rounding the corner, doing the right things, and the company is on the right track right now. What I don't like about the company, currently there's no PE, and you guys say, oh, we always look at the PE ratio, but it's so important to understand the accounting side of things and understand why is there no earnings for this company. As you can see for Q4, they had negative earnings of 93 cents per share. You're saying, oh my gosh, why do we like this company? But it's so important to understand what happened. It's actually the accounting regulations that affected the earnings per share. And what happened is they said, we're going to repatriate $300 million from overseas. And accounting rules, you have to take a tax hit on the books for that $300 million when you announce it. They didn't pay an actual cash tax for that repatriation, but on the books, they paid a book tax. So again, it's so important to take a look at cash flow because they were cash flow positive, but their earnings appeared to be negative. Other thing I don't like about this company is the target sell price of $14.69, only 15% away from the current price. That means we might have to sell it soon. Sad to see it go, but hey, if it becomes overvalued, no emotions, just results. We got to get out of it. Next company, Corning. And this is a company I didn't really know too much about when I first came on last year. And I love this company. First thing here, company has a great product. I never knew glass could be so cool. I mean, they do so many cool things. I really encourage you to go to the website and look at Corning. They do so many cool things. I spent about an hour on the website yesterday looking at all their products. They did the glass for the new Ford GT. They do like this flexible glass. I didn't know glass could be flexible. They do all the glass for smartphones, PCs, things like that. So again, I encourage you to go to that website and check out the things they do. Again, very cool. Also, they spent $3.1 billion on share repurchases last year, plus another $694 million in Q1 of 2016. Again, my dad talked about it already, but again, increasing our share of the pie. We own more of this company. I love the ownership, love to see that. Short-term PEG, only 0.27, so we're not paying very much for the future growth of this company. Target sell price of $25.08, still 37% away from the current price. It's actually number 14 on our WAM buy list right now. So a great company, as you can see. And again, they have a ton of liquidity. I pulled out the quick ratio here too, just to kind of point out a different thing. Their quick ratio of 2.23 is well below the industry average of 0.86. Now the quick ratio takes out inventory from current assets, so it provides an even more liquid measure for the company. And again, liquidity is so important so a company can pay their bills. If they have a lot of cash, short-term investments, they can do a lot with that cash. And as an investor, we love when a company has cash because it really benefits us. Things I don't like about the company, current PE has actually escalated to 55.47. And again, you have to understand the accounting measures for why those earnings escalated. They did take some restructuring charges, which I don't love to see, but the big thing they were killed by is they do a ton of currency hedges. And again, accounting rules, when you do currency hedges, you have to mark down the value of those currency hedges at the end of the first quarter. And they have about $18 billion in hedges for the Japanese yen. Now, why I like this, it smooths out the cash flow over the course of time because they know what the business is going to look like, but the investment side of the hedges actually hurts their earnings. And back in 2014, they had earnings per share of like 79 cents, which gave them a PE of about 8 because their currency hedges were positive. But they said, we like to do these currency hedges to smooth out the cash flow. And while it may appear to affect their earnings in the short term, over the long course of time, it's going to smooth out that earning and cash flow statement. Other thing I didn't like about them is they did actually have negative cash from operating activities. They had to pay down some bills, and they actually had a pretty large tax bill that they had to pay off. So they paid that big tax bill now. It shouldn't be as bad going forward. We should see their earnings increase. And also the CEO on the conference call said, we told you guys Q1 was going to be a bad quarter. Going forward, we're really excited for the rest of the year. They have some great things in the works. And they also do big display TVs and stuff. And the TV market hasn't been as good. But one thing as consumers, we like to see TVs getting bigger and bigger. Who does that benefit? Corning, because they sell glass by the square inch, or I forget the exact measure. So they're making a lot more money off the display business. Great company again. Next company is Terex. I think we called it T-Rex for a while, but we actually got corrected last time, and it's Terex. It's currently a hold on the WAM buy list. 2015 stock price change, up about 27%. That's pretty good. Current stock price around $23.45. Now, things I like about Terex, is you're getting a great value for the sales of the company. Don't really look at this too often, but price to sales is only 0.4. That's a great measure compared to the industry average of 1.76. And again, the short-term PEG is very strong for the company, coming in at 0.17. Now, this company is kind of different from a lot of the companies in our portfolio because they actually have a couple talks about being bought out and a merger. One of them is an offer for $31 per share in cash from a Chinese company, Zoomlion. So that would be a great thing if that offer goes through because we all get $31 in cash. That should be exciting. That's a pretty good return from $23.45. And they're also in talks with a Swedish company by the name of Konecranes in a potential merger. Things I don't like about this company, and also real quick on the Konecranes merger, it's actually an all-stock merger. We get some stock from Konecranes if they do merge. But anyways, what I dislike about the company is getting close to that target sell price with a forward PE of 14.42. Debt to equity continues to rise, now 98.7%. It's getting close to that uncomfortable level, about 100%. I don't really like when companies get that close. But again, we're okay with their balance sheet because we understand it. And then why I said it was a positive, the Zoomlion deal for $31 a share, there are some concerns around that because they are a Chinese company, and Terex works on cranes, and those cranes go on the ports. There's concern that the government will not allow this deal to go through because they don't want the Chinese controlling our ports. Also, Zoomlion has to get funding from the Chinese government and get an all-board approval from the current company. So there are some concerns. That's why the stock is still $23.45, not $31. So we're keeping an eye on that. And also the merger with Konecranes is not as appealing after the U.S. Treasury came out with new rules on tax inversions. The reason they wanted to merge with Konecranes in the first place was it does create a better business, gives them more exposure in Europe, but they also got a lot of tax benefits. The U.S. Treasury came out a few weeks ago and actually blocked a big deal for Pfizer and Allergan, if you guys weren't aware of that, but it hurt these companies on their taxes. So not happy to see that, but the deal does still look good if Zoomlion doesn't get the deal in the first place. Final company. I got a question in the beginning here. Who's talking about Apple? And I was like, this guy right here. So excited. I love Apple, one of my favorite companies. It's number 10 on the Wham buy list right now. 2015 stock price change, down 9%. Hasn't been pretty so far this year, especially after their most recent quarterly update. But things I like about it, we're currently receiving a 2.4% dividend yield on a great company. And the company has committed to steadily increasing that dividend over time. Why are they able to increase that dividend over time? Look at this number right here. Continues to generate a ton of cash, as cash and investments are now $233 billion. I made sure to make the billion very big so we could all see. That's $233 billion they have in cash and investments. And that's more than the $194 billion they had last year. So they're still producing a ton of cash. And they actually make prudent investment decision making. They're not just saying, oh, we have tons of cash, let's go buy out and go buy everything. They talk about, we've made a lot of acquisitions over the course of time, but we're not going to waste our cash. We're going to be very smart with what we're buying. And they also have a nice stock repurchase program going. And I'm so happy because the stock's so low right now, they're able to buy back even more stock. And they're able to increase that dividend. Curious to see if they make any big investment decisions. Talking about maybe buying a bigger company, Tim Cook did kind of hint towards, if something is appropriate, if I like the people, I like the product, we're going to do that. Next thing here, inventory turnover. Very strong at 59. Their inventory doesn't sit in the warehouse and age. It's actually turning over. It's not sitting there costing them money. As you can see, far greater than the industry average of 6. Final thing here, forward PE, only 10.27. We like to buy companies at forward PEs of 10 to 12. So we're getting a great value on this company. What I dislike, revenue has fallen by 13% compared to last year due to China and iPhones. I did talk about here, services and other products were extremely strong. And one thing to think about here is everyone's talking, oh my gosh, iPhone, it's dead, it's going to stop growing. It's okay. What happened last year was they grew by 40%. So you look at that over a 2-year time period, 40% and down 13%, that's still pretty good growth over a 2-year frame. And what happened was last year they released the iPhone 6, and this year they released the iPhone 6s. So it's a different type of cycle. And comparing the 6s to the 5s, things actually look pretty good for the company. And talking about China again, they were up 80% last year. You're not going to keep growing at 80% every year, and people just get so pessimistic when these things happen. But hey, look at this over a 2-year period. The company has done great, and we're getting a great value for this company right now. And also, they've actually been taking share continuously away from Android and other phone makers, and they have over 1 billion users now on the iPhone and other products, which means their services have continued to grow. All that Apple Care and services and such are great. I'll get to you at the end. Questions at the end, yeah. But so products as well, the Apple iWatch, everyone says, oh, it's terrible, it's not doing as well. They actually sold more Apple Watches in the first generation they did with the first generation of the iPhone, and they sold, I think it was something like 11 million units of the the Apple Watch, which is, that's pretty good. And Tim Cook on the earnings call is actually pretty funny. He said, I didn't know making $10 billion in a quarter was bad. They made $10 billion. Are you kidding me? And the stock falls that much. It's because they didn't meet expectations. Last thing I don't like about this company is debt has increased $30 billion since last year, as Apple chooses not to repatriate the cash they hold overseas, and debt to equity is now 61%. So it's pretty interesting. What Apple is doing, and you can see this on their balance sheet, is they're investing that cash overseas, keeping it over there, and if you look at the interest they have to pay on their debt and the interest income they receive from what they're investing, their interest income actually exceeds their interest payments. Love to see that. Not even worried about that. They're such a strong company. So glad we get this company at such a great value. While I didn't like to see the stock price go down, we get a great deal now. So with that, I'd like to hand it back over to my dad to finish it up and answer questions shortly.
Alrighty. Can you tell that somebody else likes to read and do this stuff as well? I think it must be in the genes. All right, let's talk about the buy and hold list here so you can see what's going on behind the scenes, what we do every Monday for our numbers day, as we call it. You can see over here our current weekly buy list. We see number one on the list is still GM. Oh, hit the wrong button there. Holy shit. Holy crap, what did I do? I don't know what I did there, but I got to go all the way. Don't know how I did that. All right, here we go. Oh my gosh. What do they call it? A fat finger? You keep hitting the button too much? Okay. Oh, I just had it. What happened? Okay, there we go. Okay. All right, so on the buy list, you can see we got to about 15 companies on the buy now. We had more in February because of the fact that the markets were down, which brings the price of our companies down, so we can buy more of them. Since then, we've rebounded. It was kind of funny. People were kind of worried. Not our clients so much. We didn't get very many calls during the quarter when things were down. And I think the market was down about 10, 12% the first, I think like February or so. But it's funny, if you fell asleep January 1, woke up March 31st, it was like there was no change at all. So again, we always talk about don't worry about the short-term craziness. But on the buy list now, you can see all the companies on the buy list here. We just love GM. They're making so much money. They don't get the respect they should have. But they also pay a nice dividend, about 4.8%. You can see right there, number 3 on the list of Pulte Homes. We talked about them. Valero's still on the buy list. Bed Bath & Beyond, which we'll talk about next quarter. I did write, and I forgot to mention this to you. We do daily smart investing. We call them smart investing daily briefings on social media. They're on Facebook and they're on LinkedIn, actually on YouTube as well. We get probably between, on average, 1,000 to 1,500 views. What we also do for you, because some of you aren't on social media, you can also go to our website, smartinvesting2000.com, go to the media tab, and click on Smart Investing Daily Briefings, and you'll see the whole list of them. And you can say, I want to know about Madison Square Garden. I want to know about this and so forth. I talk about construction spending. So you can click on those and watch them at the website so you don't have to be on social media to actually see them. And I think you'll find them. We get a lot of comments like, we love watching these and so forth. They're usually about, on average, 3 minutes long, so you get some great information very quickly. Okay, current holds, you can see our oil companies there, Chevron, PDS, and Parker Drilling. Qualcomm, they did go from a buy to hold. I was a little bit disappointed with that because of some things. I'm hoping that they will go back to a buy, but right now we're not buying Qualcomm. Chase talked about Terex already, and then Vishay also close to being sold as well. Right. The reason why Chevron, the target sell price is $71.12, it's on the hold list right now because when you look at the estimates from the analysts, the range is so wide because some of these guys at Chevron, they're doing these analysts here, they still think oil is going to $10 a barrel. So therefore, they think Chevron's going to lose I forget the range. I think somebody at Chevron wants to lose they're going to lose $5 a share. Somebody says they're going to make $5 a share. So again, the oil companies, we're not paying attention to the current target prices because the range is like 100 to 200%. The analysts are just all over the board. So great question. Normally we would sell that, but this is one exception because there's no rhyme or reason to the current earnings estimates coming out from analysts. So that's why it doesn't make sense. Exactly, yeah. You can see, we should sell, yeah. So, but again, we're now looking at, Parker Drilling had a low of 98 cents. We knew that was way, way too low. You're paying like 40 cents on the dollar for the tangible assets. Okay, So that pretty much wraps it up, but you kind of open the door as usual for questions, Kevin. So we will open it for questions, and I had some questions beforehand, and some great questions too. So now we'll open it for questions so everyone can hear the question. No questions? Okay, I guess we'll go. Yes?
You mentioned Parker drilling and the drilling companies and stuff that's considered a part of oil.
Yeah.
And the oil business is doing so well. How are those companies doing, the drilling companies?
Well, actually, oil has done, you said it's not doing so well?
Well, the drilling companies, like Parker, some of these drilling companies, I think they stopped doing that because oil got so low.
No, they're still doing operations, and when we see, like, we haven't read the full reports yet on the quarter, they are still doing operations. They're still increasing some contracts, but they're decreasing some contracts. So things are turning around, but as oil goes up in price, which it is doing, it went from a low of $26 a barrel to now around $45 a barrel. What happens is that more people are going to say, hey, now it makes sense to sell oil. We think by the end of the year, oil could be between $50 and $60 a barrel, and the companies can start making profit because then they'll have their products will be in demand. So, but again, it's this patient thing. I mean, and it did last a little bit longer than I expected it would, but sometimes, again, we'll say the word. It should be, Willis Asset Management, please have patience, I guess. You know? So, all right. Yes?
I heard two versions of why Apple stock has fallen precipitously. Like, it was like $133 or so last year. It's 93 now. And one was their opposition or their refusal to crack the code on the terrorist telephone, and people were angry with them. Other one is just competition from Samsung or Android. So I don't know what your opinion is or what you heard.
I mean, my opinion is it's just short-term craziness. And what I've heard too is, like I said, oh my gosh, you know, Apple's going to stop growing. They're not going to stop growing. They're growing their base. They're growing their users. They actually are taking revenue away from the other creators now still. And the thing with unlocking the phone, I think, was very short-term. It hasn't had a major impact on the stock price, and if it has, it's kind of short-term craziness. Again, no one's going to care about this in 2 years when we're trying to sell the thing, sell the company. Sorry, got lost distracted there.
And again, that for people that hated them for that, there's other people that liked them as well. It's really kind of like a controversial thing, but that's a short-term craziness. And again, I like your comment too about Tim Cook kind of laughing like, we made $10 billion. It's like
$10.5 billion.
Yeah.
He said here too. He said, did any other company make $10.5 billion this quarter? No.
And the thing too we want to point out about Apple, we always talk about these pre-exempt earnings and so forth that Facebook and LinkedIn and Google use and so forth. Apple gives you pure GAAP numbers, which are the most stringent numbers you can use. They don't play all these fancy games of saying, well, we're not going to include this, we're not going to include that. They include every negative that they have to say, this is what we really make. So Apple is a great company. Like any company, they'll go through difficult times. Also, too, Chase was saying on the way in the radio show this morning about, we'll tell a story about what Tim Cook said to Jim Cramer about the iPhone.
Because Jim Cramer was, holding his phone in his hand, and he's interviewing Tim Cook, and he says, I just don't see how it can get better. And he kind of laughed and said, I'm going to create demand going forward. You're not going to even know that you want these things yet, but I'm going to create that need. So, and it's true. I mean, think about the iPhone 6 now. Think about the iPhone 5. They keep advancing these things. It's like, looking back at the iPhone 1, it's like, wow, this is so cool. No way it can get better. But it has. Things get better as time progresses. Why? Because the company makes a ton of money, and they can invest in R&D to further their phones and other products even.
I think they invest about $1 billion a month in R&D. So you're going to find something. Yes?
It seems the government wants to go after companies that are making a lot of money overseas, and you mentioned Apple wants to keep it over there. If that continues to move forward, where they start by maybe reducing the interest rate, and have to repatriate that money, or their companies are making it, are they going to get fairly hurt by that, or the cost on them?
So the question is, if the government goes after these companies that have this money overseas to force them to repatriate to bring it over, are we looking at those companies to what to do with them is a question? Yeah. The government can say almost anything they want, but I do not see how they would force a company that has money overseas saying you have to bring it back. They can tax at a high rate, they can do things, but I don't see how they can force a company to actually bring it back.
Yeah, because I mean, if that becomes the case, I think a lot of these companies will say, okay, fine, we're just going to leave it over there. I'll go buy a European company. I'll go buy a Chinese company. You want to tax me on my money? I'll go do something else overseas if you want, to get our money.
And again, people can say stuff too, but I mean, a lot of stuff has to go through Congress and Senate, and a lot of stuff going on right now because the presidential campaign is starting to heat up, and I'm waiting for that big question. What do you think of the election coming up? Not going to answer unless somebody asks it. But again, that's not a concern yet until it actually goes through. And there's a lot of things that can be talked about, but there's no way that they can actually force a company to say, bring your money over here so we can tax it. They just can't do that. So, yes, Kevin.
With the new plan that you're considering, the intermediate term money fund,
Yes.
you mentioned about 4% return bond. So
4% yield.
yield. So the quality of bond is going to be A-rated, maybe triple B. Why not get more big money, AT&T, they give you a 4 or 5% return, and AT&T has good-looking blue skies above it.
Right.
So is there going to be a mix for a pure bond, but one bond exclusively?
Great question. Chase asked that question, can we put some stocks in there as well to kind of enhance the yield? I said, no, we don't want to do that because as you've seen, a stock can drop 20, 30, maybe 40%. And these are, what we're using is actually a diversified bond portfolio, so it's not just one bond we're doing. So the downside is much less than it would be on a stock. And I thought about the same thing, but we want to keep it so that in 2 years, the worst case scenario is you walk out like, gosh, I only made 2% per year, because things will still fluctuate. There's no way to give you a CD yield with no risk of principal, okay? But I looked at how can we still give you a decent return of about 3 to 4% and not have big risk on your capital. This is intermediate term money. And if I put a stock in there like a Piedmont, and a Piedmont paying a 4.2 or we have other companies like Intel, GM, okay? And that stock were, for whatever reason, decline 20 or 30%, that could really hurt the principal, and for 2 years you get nothing. My goal was to keep the principal as safe as possible and still give you a yield about 4% with diversified bonds there. So that's why we did not add stocks to that, because I want you to have a shorter time frame. It's intermediate term money.
The goal is the intermediate disbursement of the fund.
Yeah. So you're saying, you know what? I had this money in the bank. I got $200,000 in the bank. It's earning 0.5%, but yet I don't want to put it into the portfolio because it's all stocks, and I might need it, So we came up with this intermediate term, and that's why I put the question out there for it, because everybody says, like, no, we don't want that. We're not going to do it, because it does take a fair amount of time to do, but I'm trying to, again, help you out as clients to enhance the return on all your money if possible. And you should always have, money in the bank for short-term emergencies, so you don't have to cash in anything with us, but you should have that emergency money in the banks. And so we're trying to get you something in between there, so you don't have to keep that so high. Okay? You're welcome. Any other questions? Yes?
So what's going to happen during the election?
I thought I avoided
There it is.
that. I can tell you, all right, pay attention. I'm going to tell you exactly what's going to happen. Are you ready? Why are you laughing? Here's exactly what's going to happen. The market's going to go up, and it's going to go down.
And then back up. Don't end on the down. It's going up and down.
And it's going to be a lot of craziness, and it's going to move because Hillary said something, because Trump said something, and so forth. And, if he does this, it's going to happen. And 2 years from now, you're going to forget everything that said. We have no idea who the president's going to be. I'm not going to predict who the president is. I'm not a political analyst. And you're going to find plenty of people out there who will say, it's going to be Trump. It's going to be Hillary. I don't care who the president is. I care about how our businesses handle whoever that president is. Any comments on the president?
No, that's about it.
No.
I covered it.
It's just, it's going to be on the media, and I think it appears to be Hillary and Trump. It's going to be a media fanfare. They're going to love it because it's going to be so controversial and so exciting. The media is going to make billions off of this and selling commercials because of debates and so forth. In the meantime, we're going to stay with our companies. And what's the big word? Make money. No.
Make money.
Well, yeah, we want to make money, but we want to be patient.
One thing I do want to add too is our company's leaders are they're so intelligent as well. They can find ways around regulation. So as you said, it's how these companies are dealing with the new regulations and such. And I mean, they've been in business for years, and we've had, a few bad presidents over the course of time, and they still do well in spite of those presidents. So that's one thing to think about over the long term.
And I have no idea how much some of these companies spend millions and millions of dollars for legal departments to look into regulations and how to do this and how to do business. So they know about it. That's why we hire good management. That's why we don't want to overpay for these companies, so that down the road, 2, 3, 4, 5 years, I did pretty good in the portfolio. I'm pretty happy with it. So, yes? Any comments on Gilead? Gilead is a, how do I phrase it, a surprise, a little bit of a disappointment on what's going on with them. But again, it's I don't say it's like an Apple computer. They're doing a great job. They're making tons of money. They've been hit by a couple different things, but they trade at what, 8 times, 9 times earnings?
Yeah, what happened to them this quarter is actually pretty similar to what happened to Apple. They had this, this huge growth last year. I think they grew at like something crazy, like 80% last year. And now they had a slight decline. Oh my gosh, the world's ending and Gilead's going out of business. No, they're still making money. The worries over their hepatitis C drug is their blockbuster drug that brings in a ton of revenue. But that is still one of the best drugs out there. It actually cures hepatitis C versus prolongs hepatitis C. So it's a great drug, and one of the things that hurt them is actually more government subsidies came in, so that hurt their revenue. It wasn't the amount of drug that was sold, and I haven't finished the conference call yet, so I'm not completely sure on what happened, but that was the main reason we saw that fall in stock price.
And the other thing to look at too is that how many cases of Hep C is still out there. They haven't even scratched the surface of all of them out there yet. So, and again, that's what you want in the business, but you're going to have these times where, and again, I forgot to mention in my opening, what really hurt the portfolio was back last April, Apple was at an all-time high, Gilead was at an all-time high, and so, Bed Bath & Beyond, they're at highs, and now they're struggling as companies. So 3 companies out of the portfolio, still great companies, but they're dealing with some problems. So, okay. Yes?
The intermediate term money approach that you're thinking about, what would happen if interest rates were to rise if you had money parked at 4%?
That's a great question. The question is and we call it the DIP, Diversified Income Portfolio. The question is, what would happen if interest rates were to rise? And I was so against bonds because of that, because I was looking at just our corporate bonds here, our U.S. Treasury bonds and so forth. When rates go up, those are going to go down dramatically. But that's why we diversified it, because some of those bonds in there are actually bank loans, whereas rates go up, their rate goes up. So they're kind of adjustable on the rate. You also have in there international, which will work differently than what ours do. So there would be some type of pullback if that were to happen, but we should still have positive principal and positive returns over that 2-year time frame. So and then we back tested this to look at saying what's the worst case scenario. There was one case where I think part of the portfolio was way down, but part of it was way up. So we tried to make it so that when one goes down, one goes up, or one goes down, the rest stays stable. So and I think the worst case I saw that at one point the portfolio was down, I think 3%. So which wasn't too bad. And again, that was I think within 12 or 13 months. And then I think at the end of the time frame it was back up again. So, okay. Any other questions? All right. Well, thank you for coming. We'll do this again in one more quarter. Any questions you do have, give us a call. But do not panic. Again, we're going to have some ups and downs. The election's going to be great entertainment for you. Don't relate it to your portfolio. Okay.